The stock market is celebrating and investors are acting invincible. But look closely at the US dollar and you start to see the glitches. The optimism is heavily concentrated. AI memory stocks are seeing a massive surge, driven entirely by data centers buying up high bandwidth memory to fuel new AI models. This bar chart compares the AI memory rally to the rest of the market. While companies like SanDisk have tripled in value, the broader S&P 500 has actually declined 3%. When you realize that only 27% of stocks are trading above their 50-day moving averages, it becomes clear. A few tech giants are actively masking a quiet retreat across the rest of the index. Add to that the recent conditional ceasefire agreement between the US and Iran. When that diplomatic pause was announced, oil prices took a sudden dive. Retail investors rushed back in, confident the worst was over. The agreement hinges on reopening the Strait of Hormuz, allowing millions of barrels of crude oil to navigate the open ocean and reach global markets. We have a highly concentrated tech boom layered on top of a fragile geopolitical relief valve. It looks like a perfect economy, but it is a highly dangerous illusion. That illusion is already fracturing. The ceasefire is unstable, and crude oil prices have sharply spiked back up to $111 a barrel. This line graph maps the correlation between rising oil prices and surging consumer inflation. As energy costs rise, inflation follows. With inflation creeping back, the Federal Reserve is trapped. Their target interest rate is flatlining high, unable to be cut. Jerome Powell has to make an impossible choice: cut rates and risk destroying the dollar's purchasing power with runaway inflation. Keep them high and risk breaking the economy. Those elevated rates are already doing damage. They are swinging like a wrecking ball toward a massive, largely hidden sector of the financial world. The world's most powerful central bank is completely paralyzed, and that paralysis leaves the entire financial system exposed to structural collapse. Welcome to the invisible economy. Outside the bounds of traditional regulation sits a $238 trillion network of non-bank financial institutions. A massive piece of this is private credit, a $3 trillion market where unregulated funds lend cash directly to highly indebted corporations. This network diagram shows stable, traditional bank nodes linked directly to highly volatile, unregulated private credit funds. US banks have quietly loaded up on massive exposure here. These funds operate on heavy leverage, relying entirely on cheap borrowing to survive. But borrowing isn't cheap anymore. Because the Fed is forced to keep interest rates high, the over-leveraged companies relying on these shadow loans will eventually buckle, triggering mass defaults. Because the 10 largest US banks alone have over $700 billion in exposure to these funds, a shock in the shadows can instantly travel back into the regulated system. This creates a loop of two-way contagion, the same structural dynamic that turned localized subprime losses into the global collapse of 2008. Compare that structural threat with the mood on Wall Street right now. Retail investors are buying the dip and chasing tech rallies, completely ignoring the fault lines beneath their feet. This dashboard meter shows the money flow breadth ratio. It tracks what institutional smart money is doing, and it is plunging sharply below 40% into the sell zone. The professionals are quietly exiting the building. The sequence is set. Oil spikes, the Fed holds rates, private credit defaults, and the broader stock market comes tumbling down. You can look at the flashing green numbers and think the market is fine, or you can look beneath them. True financial power requires seeing the structural reality before the facade finally drops. Right now, we are watching one of the most explosive stock market rallies in a generation. But if you look past the headlines, the numbers tell a different story. Is this boom real, or is it a smokescreen hiding a massive financial time bomb? On the surface, the narrative is entirely about artificial intelligence. Trillions of dollars are pouring into the physical infrastructure required to run large language models. Analysts are calling it the AI storage supercycle. This chart shows exactly where that capital is landing. While the broader S&P 500 managed a 3.4% bump, AI memory stocks have gone parabolic. Hardware manufacturers like Seagate and Western Digital have posted massive 65 to 77% gains. Those towering numbers are creating a dangerous blind spot. Everyday investors are pouring their savings into these hardware companies, completely missing the systemic fracture forming right beneath the global economy. While retail traders are hitting the buy button on tech stocks, the institutional players, the massive hedge funds and asset managers are quietly running for the exits. This line chart tracks the money flow breadth ratio, or MFBR. It measures the net dollar flow of institutional money in the S&P 500. As you can see, institutional buying has plummeted past the threshold into severe sell territory. These billionaires are liquidating positions and hedging their bets because they are tracking two massive converging threats that the retail market is completely ignoring. Current stock prices aren't reflecting future tech growth. They are operating in total denial of a trap that is about to spring shut. The first threat originates in the Middle East. A fragile ceasefire with Iran has failed to hold the energy market steady, and crude oil has violently spiked past $111 a barrel. Expensive oil makes everything else expensive. That geopolitical energy shock translates directly into sticky, persistent inflation here at home, dumping the crisis squarely onto the steps of the U.S. central banking system. Federal Reserve Chair Jerome Powell is staring down an impossible dilemma. The Fed locked interest rates between 3.5 and 3.75%, and they are completely trapped there. Cutting rates would likely send oil-driven inflation even higher, but raising them would pressure a labor market where job gains have already stalled and unemployment is projected to climb toward 4.4%. The Federal Reserve has lost control of the economic steering wheel, and this paralysis is happening exactly as the financial system accelerates toward a cliff. That cliff is the shadow banking system. It's an unregulated sector of the financial world crushed under the weight of these high interest rates. Shadow banking is made up of non-bank financial institutions, entities like investment funds and insurers that lend money but don't take deposits. This graphic reveals their staggering scale. They currently hold $238 trillion in global assets, absolutely dwarfing the traditional banking system. Zooming in on that massive circle, we find a rapidly expanding slice called private credit. These funds aggressively lend directly to corporations, loading up on layers of high-risk leverage entirely outside of the strict regulations that govern normal banks. Traditional banks are completely exposed to this risk. US and European banks have directly loaned these unregulated funds the cash they need to operate. That direct exposure amounts to $4.5 trillion. Wall Street has structurally mirrored the leverage that triggered the 2008 subprime crisis. The core difference today is that the risk is concentrated in private corporate credit rather than bad home loans. Watch this chain reaction. Expensive Middle East oil keeps inflation high, locking the Federal Reserve into high interest rates. These rates choke highly leveraged shadow banks, triggering corporate defaults. UBS projects private credit delinquency could hit 15%, 3 times the 2008 peak. In a high interest rate cycle, the AI tech boom behaves like a classic relief valley, a temporary price bounce that exhausts itself before systemic risks resolve. The era of cheap debt and easy money is dead. The global financial system is now staring down a brutal, volatile reckoning. Millions of everyday investors are still blindly chasing flashy AI hardware headlines, hoping for quick returns. Meanwhile, the true power players have quietly repositioned their capital, bracing for the shadow banking shockwave. Surviving the next economic cycle requires looking past surface-level data. You must understand the hidden, often ruthless mechanics of how global money actually moves. If you want to stay ahead of the curve and uncover the real financial truths driving the markets, hit the like button and subscribe to Dollar Logic USA. We will see you in the next video.